Marcus was 27, working as a project manager in Atlanta, and he had just put $3,000 into a stock trading at $2 a share. His logic? Cheap price means room to grow. 6 months later, he'd lost nearly everything. Here's the thing. One simple number could have told Marcus exactly what he was getting into. That number is called market capitalization, and by the end of this video, you'll know how to use it the way professional investors do. Let's get into it. So what exactly is market capitalization? It's actually a simple formula. Take the current stock price and multiply it by the total number of shares outstanding. That gives you the entire market value of the company. This is exactly what Marcus didn't understand. He saw a $2 price tag and thought, cheap. But that company had 500 million shares outstanding, making its total market value $1 billion. Meanwhile, a stock trading at $400 might represent a far more stable, profitable company. Price per share alone tells you almost nothing. Market cap tells you the whole picture. Investors use market cap to sort companies into three main buckets. Large cap companies, those valued above $10 billion, tend to be household names. Think established businesses with long track records. Mid-cap companies, between 2 and 10 billion, are often in a growth phase. More upside, but more risk. Small-cap companies, under 2 billion, are where Marcus went wrong. They can grow fast, but they're also more volatile and more likely to fail. Understanding these categories helps you match your investments to your actual risk tolerance. For Marcus, a 27-year-old with limited savings, that small-cap gamble was way outside his comfort zone. Let's put this in perspective with some real numbers. This chart shows approximate market capitalizations across the company size spectrum as of mid-2025. Notice that the largest companies in the U.S., mega-cap technology and consumer giants, are valued in the trillions. That's an almost incomprehensible scale compared to a small-cap company worth a few hundred million. This is the chart that would have stopped Marcus in his tracks. When you zoom out and see where your investment sits on this spectrum, you start asking better questions. Like, does this company have the foundation to survive a downturn? Here's the key insight Marcus eventually learned from a mentor at his company. Market cap isn't just a number, it's a risk signal. Large cap companies have typically been around longer, have more diverse revenue streams, and are better equipped to survive recessions. Small cap companies may grow faster, but they can also collapse faster. According to historical data from academic research on U.S. equities, small-cap stocks have historically delivered higher returns over long periods, but with significantly more volatility. So it's not that small caps are bad, it's that they need to be the right size of your portfolio, not the whole thing. This is for educational purposes only. Everyone's risk profile is different. Let's look at what large cap stability actually looks like in practice. This is the S&P 500, an index of 500 large-cap U.S. companies tracked over the past 10 years. Notice something important. Yes, there are dips, including sharp ones in 2020 and 2022, but the overall trajectory has historically trended upward over time. After his small cap loss, Marcus shifted most of his portfolio into a broad S&P 500 index fund. He wasn't trying to pick winners anymore. He was buying a slice of the largest, most established companies in America all at once. Past performance doesn't guarantee future results, but this chart shows why consistent, diversified large-cap exposure is a core strategy many financial experts recommend. Let that sink in for a moment. The total market capitalization of all U.S. publicly traded companies is approximately $47 trillion as of 2024, based on data from the World Bank and major financial research firms. That's the collective value the market places on every public company in America. When you invest in a broad market index fund, you're buying a proportional slice of that entire number. Marcus eventually understood that he didn't need to find the next big winner. He just needed to own the whole market. That shift in mindset changed everything for him. So how do you actually put market cap knowledge to work? First, match the cap size to your risk tolerance. If you're young and have a lean investment horizon, some small cap exposure may be appropriate, but not your entire portfolio. Second, diversify across categories. Many financial professionals suggest holding a blend of large, mid, and small cap stocks to balance stability with growth potential. Third, and this is what Marcus eventually did, consider index funds that automatically give you diversified exposure across market cap sizes. And fourth, revisit your allocation as your life changes. A 27-year-old Marcus and a 55-year-old Marcus should have very different risk profiles. Here's one way many diversified investors think about market cap exposure in their portfolio. This is a sample allocation, not a personalized recommendation, but it illustrates the concept. A larger portion of the portfolio typically sits in large cap stocks for stability. A meaningful slice goes to mid-cap for growth potential, and a smaller allocation covers small cap for higher risk, higher reward exposure. Remember, Marcus's mistake wasn't investing in small caps, it was putting everything there. A more balanced approach like this gives you a chance to participate in growth at every level of the market, while managing your overall risk. Always consult a financial advisor for guidance specific to your situation. Today, Marcus's portfolio looks completely different. He still invests every month, but now he's in a broad index fund that gives him exposure to hundreds of companies across all market cap sizes. He lost $3,000 chasing a cheap stock price, but that lesson taught him something worth far more. Stock price is just a number. Market cap is the real measure of a company's size and weight in the market. Here are the 4 things to take away from today's video. Stock price is not company value. Market cap tells you the true size, match your cap exposure to your risk tolerance, and diversify. Start applying this framework today, and you'll make smarter investment decisions going forward. If this helped, subscribe to US Wealth Logic for more. Everything in this video is for educational purposes only and does not constitute financial advice. Market cap data and historical performance figures are cited for illustration. All investments carry risk, including possible loss of principal. Please consult a licensed financial advisor